How would you like to work in a crowded room with hundreds of people barking orders in your face all day long? Well, that was life for pro options trader Dan Passarelli, working on the trading floor in Chicago for many years. He experienced incredible highs, crushing lows, and everything in between as he honed his craft. And now he's here to share the top lessons from his wild ride that made him a better trader. Buckle up, you're about to get a crash course in options trading without the agoraphobia. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. Presented to you, as always, by TD Direct Investing. I'm your host, Rob Moise. Options Education Month continues to roll along. We've got a ton of live events dedicated to helping you learn the basics of options trading, so head over to td.com/OEM for a full list of events going on this month. Today, we're going to hear how you can trade options a little more like a pro. Joining us is Dan Passarelli. He's the founder and chief executive officer of Market Taker Mentoring. Dan's been teaching DIY investors how to trade options for the past 20 years. And he's also the author of, get this, 4 books on options trading, including his new release, Build Consistent Wealth with Options. Dan, it's wonderful to have you on the program with us. Thank you for taking the time to chat.
It's so great to be here. I'm very, very excited to be on the show.
Dan, I'm curious, you worked on the trading floor for a bunch of years. Is it as hectic as Hollywood portrays it? Like, paint us a picture of a day in the life.
Well, a typical day, no, it was not quite as exciting as Hollywood may portray it. But there were definitely some days where Hollywood didn't even go far enough, where it was just crazy, crazy time. And those are really the fun days, I'll tell you.
What kind of personality do you have to thrive in an environment like that?
Well, I'll tell you one thing, you can't really be shy. One of the guys that I trained to be a trader was, he was an Army Ranger, triathlete, just a really, tough guy. And he couldn't be assertive enough in the trading pits, believe it or not. And, we wasn't able to make it as a result.
So obviously, the personality aspect is one thing, but, you've obviously seen many traders come in and out of these trading floors over your years. What makes some successful and, more successful than the rest, basically?
Well, a number of things. I think it requires a real lot of discipline, first of all, because you're trading really you're trying to make pennies. As a market maker on the trading floor, you're trying to buy the bid and sell the offer and lock in those pennies in between. And in order to do that, you have to be extremely disciplined in your pricing and how you handle every trade. So that's certainly one thing. Managing your risk, always having risk top of mind first every time on every trade, every day you come in. That's another really, really important criterion.
And I think those are things that would serve a DIYer learning to trade options well, of course, as well. Many of our viewers are probably of the long-term buy and hold investing strategy, right? How do you think that their mindset, their approach needs to change when they're shifting to trading options versus what they might be used to with investing?
Well, I think it depends on exactly what you're trying to accomplish with options. I mean, one of the main things that I do with options is the wheel strategy, which is the topic of my latest book, Build Consistent Wealth with Options. And those of you who are familiar with the wheel strategy, you might think, how can you write a book on options? Well, I'll tell you what, they wanted me to write I forget, 70,000 words or something, and I was pushing 95,000. I still had more to say. There's just so much that goes into it. But I mean, as far as the mindset, if you're doing something like the wheel, I think it's really important to keep a lot of elements of the buy and hold strategy mindset you have, but then be open to adding that extra component to options and, be very intentional on the analysis that you'll do on the option component of that strategy.
So there's obviously a lot of management that goes into trading options. We're going to get into all that and more. Let's get down to the heart of our conversation today, your top options trading lessons from your biggest wins and losses. For those in our audience, if you want to get in on this conversation, we'd love to have you. Make sure you submit your questions to us. And there's a little extra incentive to participate this month, because if you submit a question or comment to us, you just might get your hands on some pretty sweet options education swag. We've got TD branded mugs, we've got hats with options inspired catchphrases on them, and a desk mat with options terminology and strategies on it. That's my personal favorite, by the way. Great looking piece of merch. Lots of great stuff, of course, that you can get for a lucky few. So, submit your questions to us. If you want to do that and you're using web broker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you can ask your question. All right, Dan, let's get into it. And I want to hear about some of the biggest options trading successes first. Let's start on a high note. Most options traders like to use options to, speculate on the movement of a stock to some degree, right? So tell us one of the biggest wins you had trading options to speculate.
Oh, yeah. So, I mean, when I think back to the trading floor, one of the biggest wins that I had was it was actually kind of a funny one. I had options on in a stock called Kerr-McGee, which doesn't exist anymore, by the way. And I was making markets in there, and I had a position on, basically just to kind of simplify it. It was basically a straddle position, a synthetic straddle position. So basically, if there was a big move, I would make a lot of money. And if there was not a big enough move, I would lose as a result of theta, time decay. And this was one of those days where I was running late. And I I just got onto the trading floor right before the bell rang, which was rare for me. I'd like to be there a few minutes before and really get my bearings, And I was looking at my handheld computer, and it was like, I don't know, one of the numbers just didn't look right. It's like, how could I have made $35,000? I mean, there's something wrong with these numbers. I didn't make $35,000 on this. And I looked up at the screen and I said, oh, geez, that's interesting. There happened to be a big move overnight, and it was just like one of those rare windfall profits. And I was like, oh, okay, well, thank you very much. I'll take that.
Yeah, I don't think anybody would sneeze at that kind of windfall in seemingly like the blink of an eye. For someone who's starting with options, how do they set up a trade like that? That could result in a big win like that. What would they need to do?
Sure. Well, I mean, that particular trade, just again, kind of simplifying a little bit, because the market maker positions can be a little, little wonky. But basically, a straddle is when a trader buys a call and a put on the same stock in the same expiration, and they both have the same strike price. So the idea is, if the stock goes up or down just a little bit, what you make on the call, you lose on the put, and vice versa. And as time passes, you lose because of time decay. But when a really big move happens, you'll reach your maximum loss on the put, but you can have unlimited profit on the call, and vice versa to the downside. So that is a straddle. It's a pure volatility position. But I will caution, those are pretty nuanced strategies, and it's a challenge to make money on those. You've got to really do your analysis on those and look for very specific things. I trade straddles these days just a few times a year when the situation really calls for that.
I know a lot of traders, especially starting out, like they get really caught up with the options Greeks, trying to figure out, like, how do I have to line these things up so that it makes sense and stuff like that. Do you recall on that trade, like, what did the Greeks look like? How much did you even consider them, and which ones did you consider?
Yes. So for that sort of a trade, the two most important ones, well, the three most important ones are not the ones that you would expect. It's gamma, positive gamma, which basically means if the stock makes a big move, you make money. You have theta, which basically means if it doesn't make a big move, all that time decay starts to hurt you. And then vega, which measures the implied volatility profit or loss on the option position, which is basically, I was just on another podcast recently, and I was saying, look, if I was king of options, I would change the name of implied volatility. I think it's a terrible name because it's very misleading. Instead of having the word volatility in there, I'd call it something more like the supply and demand factor of options, because that's really what it measures, just how expensive they are as people buy more of them and how cheap they get as people sell more of them. And because we're long both options, it's not really a spread, really. You can lose if the implied volatility falls.
Yeah, and we're going to talk about IV a little bit more detail just in a moment. I wanted to circle back on another Greek that I know a lot of options newbies are often pay a lot of attention to, and that's delta. For a trade like that you had where a big move really worked out in your favor, was the delta essentially like 1, or where did it sit on the scale?
Yeah, so that's really the interesting thing about straddles, is when you put them on, you're basically what we call delta neutral. Basically, the positive delta of the call is offset exactly by the negative delta of the put, and so your delta ends up being 0 when you put the trade on. But that's the magic of positive gamma. What positive gamma means is that as the underlying stock price changes, gamma measures how much the delta changes. So in that case, the stock went up a lot. Could have made money if the stock went down a lot too, but the stock went up a lot. And so every bit that the stock went up, my gamma made my deltas a little bit longer. And so ultimately the delta would end up being, basically it would start approaching 1, which is great. That's like making money just as if you're long the stock, and you started out with no directional risk, with 0 delta, and just a much less expensive position than being long the stock.
Yeah, and that's like one of the most powerful things about options, that leverage factor. So really interesting stuff. With this story, what were some of the big lessons that you took away from it that you feel everyday traders should be keeping top of mind?
Well, you should definitely oversleep and sneak in right before the bell rings. It seemed to have helped in that situation. But no, that really wasn't my plan for that. My plan was just to, to trade and scalp enough to make up for the time decay. And I know we're kind of giving a little bit of an advanced example here. So hopefully the listeners who are newer to options just kind of take away the overriding concepts and not, get caught up in the weeds. But, just going in there with my plan, and every once in a while, you get one of these highly unanticipated events, and it feels like more often than not, the events end up being bad, but sometimes they end up being good too. And, you just got to take the good when it comes.
That comes back to the trading plan aspect of things, right? Like you have to have a clear idea of, what you're getting in at, what you're getting out at, and essentially not being greedy.
Mm-hmm. Yeah. Because on that trade, I could have just said, I'm up really good right now. I'm going to hold out and see if it goes farther. No, as soon as I noticed what was happening, I immediately went and hedged and locked in that profit.
Yeah, I mean, a bird in hand is worth 2 in a bush, right? So that kind of makes sense. We talked about volatility and implied volatility a little bit. How do you think about applied volatility when you're trading options, particularly in market conditions right now that feel very volatile, unpredictable, black swanny, if you will? How do you adjust your approach when it comes to implied volatility when you're trading options?
Yeah, so in this market, it's pretty interesting. But just in general, the way I look at implied volatility on most of my trades is I look at it as what I like to call a source of edge. So on every option trade, you basically have the risks of delta, gamma, theta, vega, and really delta, theta, vega, really. So if I'm always focused on those 3 things, then I have a deep understanding of what my position is. And in a lot of ways, once you get acclimated with those options Greeks, it's actually easier to use those than to look at some of the nuances that, more novice traders look at. To me anyway, I mean, the Greeks is, God, it's just the most important thing to me.
It's a lot to kind of take in at first, and I can appreciate people get a little bit gun shy about it, and it's like all these indicators coming at you. But that's really interesting. That's like something that you need to keep top of mind. And to get back to the IV point, that's also a big thing when it comes to selling options, of course, and that's what a lot of people like to do. And you were mentioning earlier too with the wheel strategy and covered calls, you like to sell these for income. Take us through a big win that you had trading options for income.
Yeah, sure. I mean, there's one trade that I've been trading in my IRA for over a year now. And I've just gotten to the point of almost abandoning it. I've still got an order in, but we're going to see how it goes. And ironically, it's because the stock went up a lot recently. So anyway, here's how it works. There's a specific company called Bluebird, BLBD. Now, it was kind of a really boring stock for a really, really long time, but it was sitting in that like $50 range, like basically between $45 and $65 for over a year. But the implied volatility was pretty high on it. So what implied volatility measures is when implied volatility goes up or down, you make money based on the supply and demand factor for options. Now, when it comes to income trading, the reason why implied volatility is so important is because options have what's called a risk premium. The risk premium is basically like an insurance policy, right? Like an insurance policy, the actuaries figure out, okay, what is the liability for the average car in this area? Well, it's this. So we're going to charge that plus a risk premium for the policy. So we make money. That's how it works with options. They're overpriced generally. So in this particular stock, it was overpriced for a long, long time. So I would just sell a put or a call that was overpriced, and around expiration date, I would just roll it to another one, and I would keep doing this for a year. And after a year, the stock was basically in the exact same place, and I made 60% on the stock. The stock that didn't move, I made 60% on in a year. So that's, to me, why the wheel can be so powerful, because how else are you going to make 60% on a stock that doesn't move?
Yeah, that's some pretty tidy work. And the wheel, just for clarification, is a combination of selling covered calls, selling puts on the stock that you own, and kind of just continuing to go back and forth with this and earning income along the way. You mentioned like the importance of IV there. So tell us, like, when does it make sense to sell options, depending on where the IV is?
Yeah, so there's two approaches to that. You can do it actively or passively. So the passive approach is just basically always sell options, because statistically, on average, they're overpriced. Okay. And there are some people who say the only way to make money in options is by selling them. And that's what they're referencing, this risk premium, the fact that they are overpriced statistically overall. But if you want to be a little bit more active about it, they're not always overpriced. So we look and we do a volatility analysis on the options. We'll go in and we'll say, hey, what is the implied volatility on these options look like over the past 6 months? Is it in the top half of that range or the bottom half of that range? If it's in the bottom half, then they might be cheap. If it's in the top half, they might be expensive, and maybe I should sell them. Is the implied volatility higher or lower than the actual volatility of the stock, the historical volatility? If it's higher, then they might be expensive. Might be a reason for me to sell them. So, we personally, for me, I like the active approach because I've been looking at volatility on options for, 30 years, right? So it just takes me an extra 20 seconds to do this little analysis. And then I know, hey, in this particular case, they're overpriced. So I might want to do a wheel strategy. Well, in this case, they're underpriced. So I'm probably better off sitting this one out.
Okay, and I think that's a good point too, like looking at the realized volatility, because it's not like IV is just like a raw number and it's like when it's high, it's this, when it's low, it's that. It depends on what you're actually trading. So that's a good point too. But great rules of thumb there. I want to get to one last story from you, one of your biggest options trading failures, because obviously we learn a lot in our losses too. So take us through that story.
Well, I've never actually had a losing trade. Just kidding. No, obviously, I'm kidding. So one of the biggest losing trades that I had was, this was around, well, not around, it was at 9/11, right? So I had a position in Carnival Cruise Lines. Now, basically, this is again a market maker story. I was short a lot of puts that were expiring. They were going to expire in another couple of weeks. So they were zero bid at a nickel, right? No value. And so I had a choice. I could pay a nickel to close them, but knowing that they're worth basically zero. And so in that instance, I chose to not close them. I chose to just keep them on and wait a couple weeks. But as fate would have it, that stock ended up going down quite a bit. I want to say it was around 25 or 30% after, the news came out about 9/11 and the market reopened. Now, I didn't even really think about it at the time. The market was closed for about a week or after that happened. And so my risk manager, Bob, called me at home and he said, hey, so tell me about, how are you going to look when the market opens? I was like, should be fine. He goes, well, what about this Carnival Cruise Lines position? You're short some puts. And I thought, well, And then I started realizing, oh boy, I think I'm going to run into some trouble here. And in fact, I did. I ended up losing, I want to say it was like $200,000 on that mistake. But like you pointed out, you learn your best lessons from the losing trades. And so now I'm a huge proponent, and everything I teach at Market Taker Mentoring and in my books is take off risk that isn't doing you any good. If you close that risk and it's not there anymore when one of these crazy unexpected things does happen, well, then you don't have a problem.
I just can't even imagine losing $200,000 like at once. Like that just is like life-changing money, like seemingly like in the blink of an eye. Incredible stuff. So the takeaway here though is close out risk that, it's only downside, right? You're not getting compensated for it in any way holding it.
Yeah, exactly. And so many people just don't do that.
It's just an incredible gut punch. So yeah, it's better to pay like the little bit to get out of there than to not. Something for newbies to keep in mind, of course, for sure. Really appreciate you sharing all those great stories. We have a lot more to get to, of course, including our live viewer Q&A. But for our viewers watching right now, if you're enjoying the show, if you're finding this educational, you're learning a lot, make sure you check out all the other good stuff we have going on at TD Direct Investing. You can see the QR codes we have on screen for our YouTube, Facebook, and Instagram channels. Make sure you scan the codes, give us a follow, give us a like, and check out all the amazing content we have designed to help you level up your investing and trading knowledge. Now, our viewer Q&A is coming up in just a few minutes, so if you haven't got your question, make sure you do. And remember, there's some fantastic option swag that could be yours just by asking a question to today's guest speaker, leaving a comment for us as well, filling out the survey at the end. So, make sure you do that. But before we get into that, though, I want to bring in my colleague, Caitlin Cormier, because she's going to show us how to sell a covered call that we were talking about in TD Active Trader. Caitlin, welcome to the show. Always great to see you.
Yes, always great to be here.
So Dan was talking about covered calls as part of the wheel strategy and a way to generate income when you're trading options. A lot of people like that idea. Can you walk us through how to sell a covered call on the platform?
Absolutely, yeah. So we're actually going to be looking at TD Active Trader, and one of the great things about TD Active Trader, for those of you that are just getting started, is that it does have a paper trading account. So let's go ahead and hop into the platform. I am under the trading tab already in my own personal paper trading. I wish it was my personal account, but I cannot afford to lose $200,000 either, Rob. So this is my paper trading account. I'm under an option chain here. I have a security up. Along the top here, I can see the underlying. So the stock price, the bid and the ask, I can see all that volume and stuff like that. If I do not own the stock already and I want to place a trade for both buying the stock and selling the call at the same time, I can start out just by clicking this little, I'm going to go to the ask price to purchase, and I'm going to click this little plus button beside that says spread. When I click that, I'm going to see my order entry pop up down below, but I only have, of course, the purchase of the stock so far. I need to also add my call. So next, what I'm going to do is I'm going to look through my option chain. I'm going to choose whatever time frame. Let's just say we want to go July. And then I'm going to choose whatever strike I would like. Again, however you want to, whatever one you want to choose. And we're going to come on the far left side of the bid price, because that's what we would do to sell. And we're going to click that plus button again, and it's going to create a spread for us. So it's going to show us it's a covered stock. It's going to give us the net price here. So the cost of the stock less the premium we're taking in. And it has it all filled out for us. So when we're ready, we can just go ahead and click confirm and send. It'll pop up and give us our max profit, our potential max loss, our resulting buying power, all that good stuff. And we can go ahead and hit send to send that practice trade.
So I think a lot of newbies, especially looking at the options chain there, are thinking, I don't really know which one to pick. Like, which one is going to give me, the success rate or, assumed success rate that I'm looking for that, makes sense with the risk and reward I'm willing to take. How can they get a sense of that looking at the options chain?
Yeah, a crystal ball would be ideal in this situation, but obviously, we don't have that. So we have some different tools that we can use, though. And one of the tools that we can use is Delta. So Delta, essentially, it has two functions. On the option chain, it's way over here on the left-hand side. I'm not sure if I don't think you can see my pointer here, but it's way over on the left-hand side of the option chain here. And it does two things. The first thing it does is it tells us how a change in the stock price will impact the actual premium for the option. But the other thing it does is it gives us an idea of the likelihood of the option expiring in the money. If we are looking just to simply, continue to hold the stock and sell the call, then maybe we want quite a low likelihood of it expiring in the money because we want to hold the stock. So then if we're looking here, for example, the one that I had moved forward with, I think was the 87.50. That one had, for example, a 14 delta, or approximately 14% chance of expiring in the money. Now, of course, it's just a tool to use. It's not an exact science, but it can be at least one of the things that we can look at to understand the likelihood of a particular option expiring in the money, depending on how close it is to the current stock price.
All right, fantastic stuff. Yeah, no crystal ball, but hey, indicators like this can be helpful, especially as you're trying to get your feet with options trading under you. Great stuff, Caitlin. Thank you for showing us, as always. That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. And just a heads up to our viewers, if you want to learn more about options trading, make sure you check out Options Education Month at TD Direct Investing. Like I mentioned, the whole month of May is dedicated to helping you learn how to use options to get closer to your financial goals. So scan the QR code on screen for a full schedule of events. All right, Dan, let's get into it right now. We got our live Q&A on tap. Lots of questions coming in. Are you ready to see what people want to know more about?
Let's do it.
All right, let's fire it up. Let's get to our first question. And this one is coming to us from Paul. When, if ever, would you roll a losing trade into the next month? And what signals or rules of thumb would you use to decide?
So with covered calls and cash secured puts, I do this all the time. I was just doing that in my IRA before the show started. The things that I like to do is when the stock goes through the strike price, that's typically my indication to roll. And the trade is often a loser in that case, but if enough time passes, it might actually even be a winner too. And it doesn't matter to me either way. what I do is if it's a covered call, I'll roll up to a higher strike and out to a further out expiration. And I don't really pay too much attention to whether that specific leg that I'm closing is a losing trade or a winning trade, because I know in the long run, if I'm doing this the right way and I'm using all the right criteria, including selling overpriced volatility, then in the long run, I should make money. Statistically, that's what should happen.
When do you make the call to say, I'm not going to roll, I'm just going to cut my losses with this one and try again another day?
Yeah, so when a stock continues trending, and oh gosh, I probably have one of those in my IRA right now. I'm trying to remember which one it is. But when a stock continues trending, I'll usually do that roll that I just described. And then it trends again, and I'll do that roll that I just described, and it trends again. And at some point, I'll just reanalyze, especially from a fundamental standpoint. Like, is there something really different going on here? Oh, Intel is one of these situations that I'm in now. I did choose to keep rolling that, but I rolled to an in the money, and at some point I'm just going to let it get called away. I rolled to a September option, and if it just keeps going, as the news comes out that they're going to start making Apple chips again, I just can't keep limiting my upside. I'm going to stop selling covered calls at some point on it.
Okay, yeah, so good rule of thumb. Obviously we focus on the technicals, but also the fundamentals are a big part of this thing too. Let's get to our next question. This one coming to us from Bradley. Bradley's asking, the wheel caps your upside by selling calls, but leaves downside risk open. How do you mitigate that downside in practice?
Right. So this is why I think it's very, very important to realize that this one strategy, the wheel, is comprised of basically two components. It's comprised of the stock component and the option component. And we do need to look at it as a single strategy, but we also need to look at it at what is the quality of this stock. To me, almost every wheel trade that I make, I want to be long the stock. If I'm selling a cash geared put, I want to get assigned on it. If it's a covered call, I want to keep the stock. So as far as the downside risk goes, I don't really care. It's the same as if I just bought a stock in my IRA and held it. I'm not planning on selling it tomorrow. And if the stock doesn't work out, because they're not all going to, well, that's fine too. Overall, if I have a very diversified portfolio and have some skill at doing this, I feel very confident I'm going to, make money in the long run. The S&P 500 makes about 10% a year on average. So I don't worry about the downside risk because they're stocks that I want to buy and hold. And as far as limiting the upside, if I'm always selling options when they're statistically overpriced, sure, I'm totally going to give up upside on some stocks now and then. But overall, the premiums that I'm collecting should more than make up for the upside that I give up.
That's a really good point that you have to make sure that you're using a lot of these strategies on something you actually want to own if it came to it, right? That's a big way to limit your risk. So really good point there. Let's get to our next question. This one coming to us from Sukhdeep. With a professional mindset, how do you take losses? How do you know when to pull the plug, and what specific strategy or rules do you follow?
Yeah, well, there's a saying, a professional trader told me this back when I was just getting started in this industry. He said, if you want to make it in this business, you have to be good at taking losses. Or no, you have to be good at losing money is the way he put it, which, sounds very counterintuitive. But what he meant was to take those losses and try and keep it out of that psychological compartment in your mind that hates taking losses. Just lock it in. This is a statistical game. This is a numbers game. And it's a situation where if you make 1,000 trades, you're going to have hundreds of losing trades. It's just how it works. So it's not psychologically easy. And there's a lot of like economic behavioral psychology that plays into there. But I think the more you trade and the more you realize that it's a statistical game, it's a numbers game, it's a game, it's a game that's measured in miles, not inches. You can train your brain to not get so upset about losses.
We were speaking with an options trader just a couple of weeks ago, and I thought you made a great point that everybody has access to the same fundamentals, the same technicals. The difference maker is going to be what's in between your ears, right? Like your mindset and your approach and stuff like that. I thought that was brilliant, and you're speaking to that as well too. So great stuff. Let's get to our next question. This one from Andrew. Strategies for writing covered calls to generate income while keeping shares and avoiding large embedded cap gains. Thoughts on weekly versus monthly, target deltas, resistance to levels to write at, and timing, all that good stuff. When you're doing covered calls, you want to generate income. What are some of the key things that you're looking at there, Dan?
Oh boy, I could write a book to answer this question. Oh wait, I already did. Yeah, I mean, really, there's a whole bunch to that. I mean, the things that I look at are how do I maximize my profitability on this? So one very broadly, broad brushstroke way to think about it is, let me look at the option chain and say, if I sell this strike, am I better off selling 4 1-week options in a row or 1 4-week option? And I can do very simple arithmetic to answer that question to see which is better. I can also look at the theta. Now, another component that plays into here is to do the ROI calculations, to calculate the annualized returns. And this is something that almost nobody does. And it's probably the single most important thing if you're going to be successful at the wheel strategy. You've got to look at the ROI metrics. You got to look at the annualized return. You got to look at what I call the skate yield for cash cured puts, or the annualized static return for covered calls. These things are just, you can't trade the wheel and make money in the long run without them.
Speaking of thinking of annualized gains and stuff like that, I know it's obviously going to differ depending on the strategy and stuff like that, but do you have a rough rule of thumb? You're like, I need to make this annualized for this to even be worth my time and my effort and my risk that I'm taking?
Exactly, because it's not risk versus reward. It's risk versus reward versus my perceived chances of success. That's where the rubber really hits the road. So yeah, I mean, I might look at one potential wheel play and say, okay, this has a 15% annualized return. And on that wheel play, I might say, yeah, that's great. I'm in. I like that against what my perceived risk is. But on a different one, it might be 15%, and I might say, oh, no, that's definitely not enough for the risk involved in this situation.
Okay, so always a situational call, but kind of nice to hear the rough guideline that you like to use. But of course, yeah, very situational. Let's get to our next question. We have another one coming to us from Austin, and a bunch of people have the same question. What option strategies do you think are most suitable for beginners seeking retirement income?
Okay, that for sure is the wheel strategy. And the reason why I say that is because, well, first of all, retirement income was the tip off right there. The wheel strategy is just basically an extension of the buy and hold. So it's great for retirement income. Additionally, on the surface, it's a fairly simple trade. You can get 80% of the way there by just, I could sit you down for 20 minutes and teach you the basics, and you're kind of 80% of the way there. The reason why I wrote a whole book on it is because the other 20% is very nuanced. But that's the way I would go. They're very easy. Covered calls and cash cured puts, they're very easy to conceptually understand, and they're great for generating income for retirement.
Okay, so something for folks looking for retirement income to consider. And of course, you got that book that you just released there. So, some reading material perhaps if they want. Let's get to one last question. This one's coming to us from Sadala. Hope I said that right. Which option strategies have been most effective for you over the years? And do you prefer directional trades like, long calls, puts, or income-based strategies?
Okay, so there are a few trades that we specialize in here at Market Taker Mentoring. Definitely the wheels, so income trades, but also another one of the strategies that we spent a lot of time researching on and refining and have gotten really good at is earnings trades. Now, earnings trades is nothing like the wheel. That's where I buy a time spread the day before an earnings announcement and I sell it the next day. Now, I don't just do this universally on every earnings announcement. There's a number of criteria that go into trade selection there. If there's like 10 earnings announcements today, I might end up trading one of them that might meet my criteria. But yeah, that's another really, really great one is my earnings trades, wheel trades. Oh, what else do I do? Some unusual activity trades like short squeezes and credit spreads, time spreads, wing spreads. Okay, yeah. There's a lot of strategies that I use.
And obviously not enough time to talk about all of them, of course, because we've run out of time here, but appreciate you putting those on our radar. For those who are interested in learning more about those strategies, again, td.com/OEM. We got a bunch of workshops that you can check out to learn all about these strategies and more. But Dan, listen, really appreciate you taking the time to walk through your highs and lows and the lessons that you learned from them from your trading career. Really appreciate you taking the time.
Yeah, thank you so much for having me. This was fun.
And of course, for those in our audience, thank you for tuning in as always. Make sure you check out next week's episode. We got another good one for you. DIY investor and trader Bilal Dalich is going to explain how buying call options has helped him supercharge the value of his stock portfolio. And he's going to show us the ins and outs of how he does it. Really interesting stuff. You don't want to miss it. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks again for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.